you so much for listening. Today I would like to introduce football field analysis in finance. When you start a valuation exercise or you start your job in M&A, investment banking or finance, you may come across the term football field analysis. And initially, sometimes for young professional or students, very confusing. What are we talking about? So I would like to give you an idea what this is all about. I'm not going to show you how to do it in Excel, because usually you would use the bar chart or line chart functionality in Excel. There are so many videos on YouTube where people show how to technically do it. I don't plan to cover this today. In general, a football field analysis in finance, it's not a separate calculation or analysis. It is just a visualization that compares different valuation methods. Yeah. So here in my example, we have 5 valuation methods: leverage buyout analysis, discounted cash flow analysis, precedent transaction analysis, comparable company analysis, and 52-week trading range. I will also not explain those techniques and analysis. I have done some other videos where you can see how to do those calculations. Football field is all about visualization. So if we look at LBO, for example, this is an estimated value based on a financial buyer's expected return. DCF, as you may know, estimating the intrinsic value based on future cash flows. Precedent transaction analysis uses valuations from similar M&A deals. Comparable company analysis uses valuing a company based on similar publicly traded firms. And then 52-week trading range basically shows how the stock has traded over the past year. Yeah, so you have different analysis. You can use other ones as well, depending on the case, on the analysis. So you don't need to use all those 5. Sometimes you can use additional analysis. It doesn't really matter. Football field, you have all your methods. And then on the x-axis, you have your valuation. You can have your valuation as a total enterprise value in million US dollar, or you can show it per share. Yeah, doesn't really matter, just you need to stay consistent, otherwise the scale doesn't work. Typically, the football field analysis is displayed as horizontal bar charts with different valuation ranges plotted along a price per share or enterprise value axis. Each valuation method is shown as a separate bar. Yeah, what does it mean? If you do an LBO analysis, depending on your assumptions and your calculations, you may have a base case, a bull case, a bear case, which means worst case and best case. So you will come up with a range. For the DCF analysis, you will have a range as well. For example, here 1 billion to 1.3 billion. Precedent transactions will give you this range. Comparable analysis will give you this range, like 950 million to 1.1 billion, and then the trading range potentially gives you this range. Very important, when we do valuation, we are not concerned with finding the right number, because there is no right number. It depends on your assumption, it depends on your narrative, it depends on your investment thesis. For example, if you value Coca-Cola, you may think about, hey, Coca-Cola is pursuing an expansion strategy over the next years. So you're thinking about revenue growth, market expansion. Another person could think, no, I don't believe that Coca-Cola is able to have a market expansion. I believe they focus on cost-cutting exercises. That's where you may think about decreasing SG&A and cost of goods sold space, which will give you a completely different scenario. So that's why very important when we do valuation, regardless of which method we are using, we are not looking for the one specific number, because this number does not exist. What we want to do, and we use sensitivity analysis, which I will explain in another video, to get certain ranges for each. And then again, after we have come up with those ranges, worst case, best case, then we overlap them and see, okay, what do we think is our valuation? So here, for example, if I would assume every analysis is used 20%, so 20% weight, 20% weight, 20% weight, and so on, I may have a valuation somewhere here. So near 1.1 billion. Yeah. What we do as well, and this depends on the case, we assign weight. So we say, hey, for this scenario, we think DCF, because it's quite a comprehensive analysis, should actually account for 50%, 52-week trading range. This is just the historical stock price, which you know, sometimes driven by emotions, 10%. And then we say maybe we use 20%, 60, 80, 10, 10, 70, 10, 10, for example. Yeah, then you know potentially, because we're using 50% here, maybe your bar chart would actually move more to the right. It depends on the weight. But what we usually do, we assign weights for each method to say what is a proportion of accounting for this, and this really depends on the case, depends on how much effort or detail and what information is available. And then what we do, we assign a kind of approximate valuation. Yeah, again, once we have a valuation, the other party, if we talk about an M&A deal, may have a different one. It all serves as a starting point for negotiations to say, okay, what is the range? What do we assume? Yeah, so very important, football field, it's not a separate calculation. It's not a standard technique. It's a visualization exercise. Second, in valuations, do not try to find the right value, because it doesn't exist. It's all about ranging. It's all about different scenarios, probabilities, where we use football field. And also, especially when talking about football field, it is used for quick decision makings, negotiation tool, and clear communication, because it summarizes complex valuation outputs into a simple visual format. Good. I think you found this useful. Again, there are so many videos how to do it technically. Let me know, and I look forward to do some of the other videos on LBO, DCF, precedent, transaction analysis, and so on. Thank you so much. Bye bye. See you in another video.